So thank you for joining us this afternoon. My name is John Stenhouse. We're at the University of Essex, and this is Angels at Essex, part of the University Enterprise Zone, where we're running this program of webinars on investment readiness, where we prepare businesses and founders and innovators to become ready to move into the equity market. This series of webinars covers a number of topics, and today it's all about exit strategies. It's have you planned your exit strategy? What would your exit strategy look like? And which ones you should be considering, and perhaps which ones you shouldn't. But before I start, I'd like to just mention that these sessions are being recorded and that we would actually welcome all your questions. There is Q&A, so please leave your questions in the Q&A. We will send you messages through the chat box, and we hope that you will engage by using the Q&A throughout the course of this webinar, and there will be golden opportunities to ask those very pressing questions that you need to get answered. So please take part in this. This is a two-way adventure. Now, I would like to know a bit about our audience. So first of all, I am going to run a poll. Now, just remember, this is being recorded, but the poll results will not be recorded. They don't actually appear in the recording. And these will be made available, the actual recordings will be made available to you afterwards on YouTube and in podcasts. But please give us a week or so to get these prepared, because they will need editing to take out any of the glitches, which we do have from time to time. If your internet does drop out, then please feel free to come back on board again. And we'd like you to be there for the whole session, which would last anything up to an hour. So I'm now going to ask the audience a question. So our opening poll, do you already have a planned investment strategy? It's a single choice. There's no wrong answer. It's either yes or no. So please take part in this poll. I think we've had the vast majority. And so what are we looking at? 80% of our participants do have a planned investment strategy. 83% have a planned investment strategy, leaving 17% do not. Now, not to worry about that, because this is available to both parties, okay? So I'll be very interested at the end of this session if you still feel the same. So I now close the poll, and I would now like to take the advantage of introducing your guests today. We have with us Christian Bucko and Victoria Sprozik from the University of Essex, who are here to facilitate and help us. But our guest speaker today is Lake Falconer from PEM Corporate Finance. Now, Lake is a specialist in firms, businesses wanting to exit, and his specialist area is in high innovation. And I'm now going to open the forum to Lake. Lake, introduce yourself and please talk about the topic of conversation today.
John, thank you for that kind introduction. Well, just to introduce myself and also give you a bit of context as to where I'm coming from in terms of exit strategies and value building in companies. A little bit of my background. I'm a chartered accountant who had the good sense to escape from accountancy pretty much immediately on qualifying to go into private equity, venture capital, investing with 3i, which back in those days had a network of offices around the country, and we were backing all sorts of local independent businesses. I lost them some money, but on the whole, I made money, and I think I came out nicely ahead. And lots of tech, lots of growth businesses, and we also backed startups at that stage. So great learning process for me. Not for nothing was 3i known as the University of Venture Capital back in those days. Most of my career since then has been as an advisor, helping people to buy and sell businesses, to do management buyouts, either as a buyer or as an exit route. I do a lot of exit planning, helping people work on their exit routes and how you get there. And I also spend a lot of time on valuation. I have also spent a couple of years as a finance director in industry. So I guess you could say I've got a useful sort of three-way perspective on building value in companies as an investor, an advisor, and also having been a director in a business. So I hope to bring you some insights and in this overview based on my experience. I should say that most of what I'm going to say isn't just relevant to founders. If you're in a family business, or if you bought a business along the way, these things are very much relevant. But I guess the point around founders is you should be beginning to think about this probably on the day before you start the business, right through to that point at which you achieve the exit. Now, what I'm not here to do, just before I dive ahead, actually, a quick overview, you'll see it on the screen of what I'm going to cover. I'm going to kick off with a bit of an update on the market, which I think is always relevant. And then I'll talk about exit planning, and then about the specific most likely options that might be available to you, and give you some practical thoughts on them. To have a bit of a slide freeze. There we go. Yeah, so what I was going to kick off by saying is I'm not here to tell you what your business strategy should be. I'm sure you've all got well-developed strategies for your business. You've already decided which wall to put your ladder against. You can already see the steps that you need to take going forwards. But just to stretch that analogy, exit strategies are all about how to know, frankly, when you've got to the top, or how to decide if it's actually good enough or timely to get off early. It's all about having an exit of your choice at a timing that you have selected. So first off, the M&A market. I'm going to summarize the M&A market by looking at what's happened in the run up to where we are now, particularly from 2020, in 3 pictures and 4 graphs. Going back to 2020, in many ways, that's when it all changed. And actually, this is, for me, the defining image of M&A in 2020. There was a time when everyone was much more concerned with whether they were going to buy toilet rolls than what they were going to do with their business. I'm sure we all remember that. And I can report, moving on to the graphs, that actually activity level just floored. This is a graph from the Institute of Mergers and Acquisitions. This is EMEA data, but you can see their deal volume just hit the floor in that second quarter of 2020. What's interesting, though, is how quickly it came back. From personal experience, we had some deals which kept running, and they were all in sectors where that makes sense. I was selling a digital learning business, and I was selling a healthcare software business, both of which were doing really well despite everything. And interestingly, you can see how levels have come back since then. Taking a longer term perspective, and this is data from PitchBook going back to before the financial crash. It's amazing how the financial crash doesn't look so exciting when you smooth it out. But at the time, that was a real downturn. And again, in this one, you can see the effect of 2020, and you can see pretty steady prognosis going into 2022, although of course we don't have full data for that year yet. More specifically, and this is from Mark to Market, which is a fintech data provider we use for valuations and M&A work. This is UK deal numbers, remarkably consistent over the last year. And I guess that's what I'm seeing. This is probably why. This is a Deloitte survey. This admittedly was done going into the back end of last year, so before we had war and inflation rampant. But in terms of the intent, as you can see from that, big corporates overwhelmingly planned to continue or increase the amount of acquisition work they were doing. So all I can report is that we, in common with most folks in our industry, are really busy. There's lots of transaction activity. There's lots of appetite to provide exits for entrepreneurs, driven, I think, by the fact that a lot of businesses are doing well against this strategy. There's loads of liquidity around in the market. There's no alternative homes for the money. And actually, despite everything, the UK remains seen as a very favourable jurisdiction in which to do business. And of course, as the pound sags, that clearly helps, and we still see a lot of overseas buyer activity. So generally speaking, it's probably not a bad time to be thinking about your exit planning. And these are the sorts of factors that will influence it as and when you get there. I do a lot of exit planning work. But one of the other things, I did say 3 pictures, didn't I? The second of my pictures is uncertainty. And that there's clearly been a lot of since COVID and now. And where I think you will find this impacting is through valuations to some extent, although not that much as yet. But I think in the way you access those valuations, so when you come to the exit, it's going to be supremely important to have modeled different scenarios, to have your business narrative really well articulated, because it's very much now about the underlying performance and potential of the business. And the story matters every bit as much as what's my multiple of earnings. So much so that during COVID, that's when the real drive to dig into underlying profit came from. Because of course, a lot of businesses, great businesses, had depressed profit. Now we normally measure profit for valuation purposes based on EBITDA, which is earnings before interest, tax, depreciation and amortization. During COVID, the number that was bandied around a lot was EBITDA, which is EBITDA plus COVID. So popular was it that year that you could even get a mug with it on it if you were keen. But I put it up because I think the concept is still relevant. It's very much about what is the true value of your business to the next buyer, owner, in terms of thinking about exit strategy and having a narrative that supports that. Exit planning. When I'm doing exit planning with people, I think time horizon is always important. If it's a sort of 2 to 10 year horizon, then I think it's worth doing a full exit planning review. If you're closer, I guess my message is it's not too late by any means. It's never too late, but it's probably much more of an exit readiness scan. And what do I mean by these two things? Well, an exit planning review, which I guess is what we're talking about for the most part here, is you should end up with a plan outlined and some key actions and expectations as to what are the personal drivers of the business owners. Start with that. Are they congruent? Are you all going in the same direction? What's M&A activity like in your industry? What are your trading history and prospects? Then, of course, the all-important multiple of earnings that you might get. And probably just as important, picking up on my earlier point, what are the value drivers? What are the key intrinsic features of your business that will drive the multiple? Just as important, what will your buyer look like from a buyer's viewpoint? That's a lens that I always encourage people to try to use and to envisage. And all of this will influence the different exit choices that you're going to have. And I'm going to talk about the different most likely exit choices later on in this talk. And then the other thing you need to think about is exit timing, which is partly readiness in your business, partly in the market, and partly, of course, against, coming back to the start, against those personal objectives of the business owners. At the end of that, you should have your key strategic actions with timings and responsibilities. A word of warning, if your key strategic actions can't be enlisted on the fingers of one hand, then they're probably not strategic. There needs to be a bit of focus about it. Exit readiness. If you're getting closer, there's still time. I guess what I mean by that is if you're getting close enough to the anticipated exit that you have visibility of the market and business cycle for your business, but far enough out to actually do something to address any potential weaknesses in your story and to establish a meaningful track record profit-wise. So the key questions at that point would be, is your proposed timing still right? What is happening in your company's market? Are valuations still attractive? How are they trending? Is the originally anticipated exit route still practical and preferred? Is a trade sale going to happen, or do you need to think about a buyout instead, for example? What other performance improvements might allow you, even now, to capture more value? And then really important, have you got a pipeline beyond your ownership period of value creation initiatives that could extend after that sale? Because you need to leave something for the next guy. People talk about leaving gold in the ground for the next buyer, and that does influence people's price and the multiple that you might actually get. This is an example from an exit strategy review that I did with a technology and technology services business a couple of years ago. And the top half of the page is a sort of current state, future state analysis of where the business was and where they would like to get to, with the key actions dropping out in the gap. And obviously they need to fit with the overall strategy. In this business, the key actions were mostly to address the imbalance that they had between, they had a large lower margin services business and an intellectual property driven products business. And the lower half of the page, we've got some radar charts trying to snapshot the business based on the key points that will drive value in a sale. And these are based on some survey work. There's a big corpus of data in the US as to what key features have influenced exit multiples on SME sales. And it's quite effective as a predictor. 5 is good on these charts, incidentally, and 1 is weak. So you can see over on the left, this was a business with great customer satisfaction and great potential. But initially, it was pretty weak on overdependence on the owner and defensibility of some of it. And by the end of the planning period, surprise, surprise, all of them are better, having built second tier management, improved profitability, and also built some more recurring revenue into the business, which everyone likes. The business actually went on to be sold successfully. In the end, the best logic, the best value came from splitting it, actually. So the products division went to a tech buyer for a really nice value because they really valued the product. And the services business went to an MBOT. So it's a real example of how you can get your strategic exit planning to actually work in practice. Now, I mentioned earlier, it's really important to think about your business through the eyes of a buyer, because that's a great way to shape it. Based on selling a lot of businesses and also working with companies to make acquisitions, this is my take on the top 10 things that buyers would look for. No surprises, financial performance at the top, but people are really looking for sustainability and insight into risk and scalability around that as well. Obviously, growth potential. Basically, you get more if you're growable. So is it scalable? What are the synergies? What's the customer base like? The absence of dependencies on owner, suppliers, and customers. A positive cash flow cycle. That's quite important. A buyer wants to know, will I have to tip more money into this thing once I bought it? And if so, you're not going to get so much for it. Some businesses have profoundly cash generative models as they grow. Some businesses absorb cash as they go, and that influences value as well. Customer analysis, customer appeal. Is there any concentration in the customer base? Is there any uniqueness about your offering that is engendering loyalty out there? Recurring revenue. I think everyone knows that that's the holy grail. Consistent revenue generation is what people are after. Intellectual property is, of course, of intrinsic value, but no one will pay it for you, of course, if they can't monetize it and generate a cash flow for it. Key employee retention. People will really want to drill into continuity of employee relationships and relationship building within the company. In every company, some more than others, it's the people that are important, and it's the people that people will buy. Sector, is it a growth sector? Are there exposures to imports? What's M&A activity like in the sector? All of these things matter. And finally, brand. But I would say brand only if it's actually critical to revenues. Some people bang on about the brand, but actually it's not really what's driving things. So that's some insight, I hope, into how you might think about exit planning. Frankly, I would encourage everyone to get on with it because it's a really interesting process and it's a different perspective on your business. So before going on now to talk about what some of the actual exit options are, I'd like to break it up a bit and run a bit of a poll. And John is my poll meister who's going to drive this, I hope. So a couple of questions, basically. So there we go. Do you have a formal exit plan? So if you'd like to take as many of these as you like. Is it written down? And then what's the sort of time scale? And there's a strong vote there for I don't have one. Longer time frame. It's fascinating watching these things in real time as they come in.
Don't be shy, people. And yes, it is multiple choice. So, you know, if you're not sure, you can tick as many boxes as you like. I think that is about it. No one's got one that's written down.
That's not surprising, to be honest, in my experience. I think people get put off because I think it needs to be War and Peace. It can be a few slides. And an interesting spread of exit timescales for people as well. I guess I should probably also ask what sort of age profile was of the businesses and so forth, because that would have influenced it as well. But okay, so quite an interesting spread. As I say, not uncommon to not have a formal written plan. Interesting how many people haven't really thought about exit. Okay, well, my second question was really around if you did have an exit in mind, what do you think it was? And we have a question with some multiple choices for you. So trade sale to private equity, I've lumped employee deals and buyouts together, a flotation or IPO, no idea, or I'm going to keep it forever. In which case you need to do some inheritance tax planning, incidentally. Okay. Still coming in.
Yes, that's about it now.
Yeah, well, that's an interesting split. I think that probably, based on what I see, I'd probably see a bit more in the way of sales to private equity, but otherwise, and I, just a full disclosure, I get involved solely with unquoted businesses, so I don't typically see people who are looking at the IPO as a final route. Okay, so there's a real interest, I guess, which we can reflect in the rest of the talk. Really interested in sort of trade sale and potential employee deals or buyout deals. Okay, thank you. Happy to move on, John, if you think you've got enough thoughts in.
Yes, we can move on now.
Okay, so what I wanted to do is just to run through with you the sort of key exit options you might have. So just to give you the headlines and then some more detail to follow. Liquidation, of course, is generally pretty bad news, but it's sometimes the route if a trade is sold separately as a way to get cash out of the business. Employee deals can be useful, particularly knowledge-led people businesses, to address succession, reward, and retention. And employee ownership trusts, EOTs, and buyouts do similar things but have quite different tax benefits. More about that later. Mergers, frankly, rarely occur. It's usually somebody bigger buying somebody smaller. But I think what people often mean by merger is a one-to-one negotiated sale, rather than the alternative, the covert auction, the marketing of the business to achieve a trade sale. Private equity deals can be similar to covert auction. They're often engineered via an auction alongside a trade sale and might give you the best price depending on the market. IPOs, as you know, are complex, but that can also give you the best price depending on your business dynamics. And of course, if you're planning on going on an acquisition spree, it's useful to have quoted paper to fund the deals. So moving on to talk about trade sale, as I say, two flavors, the one-to-one negotiated sale or the covert auction. Wrestling down one buyer. This is usually where someone has knocked on the door, in my experience, and it happens quite a lot. And the question there really is, if that strategic buyer knocked on your door unexpectedly, how would you feel? Would you be prepared? What kind of first impression would your business make? This is where exit planning comes in. Obviously, if you have just one buyer, it's much harder to get competition. But if you do have the right buyers, deals can be done. And I've advised on a lot of those. It's often driven by a feeling that there's enough money on the table potentially, and a feeling that it's the right buyer and the personality fit. I've seen a lot of these over the last year. For example, I sold a Cambridge-based business, bioscience business, and blood products business, both to a Scandinavian buyer, and another engineering calibration business, which went to a Dutch buyer. Those were all knocks on the door, which should be unexpected, and ended up in very good deals, both financially and qualitatively for the sellers. So don't dismiss it, but pick up the phone to someone, whoever advises you, as soon as the approach comes in, so that you can manage it appropriately and land the fish if it's something that you actually want to do. If you're taking a much more planned approach to this, then you're probably thinking about actually auctioning the business. And that sounds alarmingly public. It's not. It's very much of a covert auction. The aim is to get multiple motivated buyers into competition with one another, and it really is a truly competitive process. I've seen the best offer being way better, multiple of the lowest offers that come in. It's typically a 6 to 9 month process. It can take a bit longer, just depends. And as you go through the process, the number of buyers that you are talking about your business to will decrease, but at the same time, the amount of information that you're sharing goes up. So it needs to be controlled. And this is a very simplified process chart for this. Well, there's basically 5 stages as you go through. Planning, so that's looking at alternatives like buyouts and employee trusts, tax work. Packaging, that's preparing a good selling document, and the narrative is really important here. It's not just about the numbers. And from that selling document, there's a distillation, which is a 1-page anonymized summary, which gets used in the marketing. Obviously, some businesses are rather difficult to anonymize, and that can be a challenge. This is when you prepare your list of buyers to approach. And I'm often asked how many should be on it. Well, the answer is if it's half a dozen, that's probably not enough. If, as is some of the business brokers out there will tell you, you should have hundreds, that's far too many. There won't be hundreds of people who want most businesses, and that really is washing your linen in public. I think the right answer is a thoughtful, research-driven list with tens of buyers on it. It works. Marketing, this is about making outbound calls to board-level directors of the potential buyers to say, have I got an interesting deal for you? Following that conversation and having agreed a confidentiality undertaking, they will then and only then get to know the name of the business and get the information. And then it's about driving the potential buyers in front of you, the business owners, to make a presentation. Because ultimately you will sell your business best across the table, and you probably want to look the buyer in the eye and get a feel for them. From that, we move on to the selection process. This is when you've actually got offers coming in, forms of letters of intent, non-binding offers, and we play them off against one another. And if you've got even 3 or 4 buyers, you can have some real sport, and you can really enhance the offers that people put on the table. Because remember, they want your business and they know that they're in a competitive process. Then you get into the closing phase. This is where the lawyers get involved, where the buyer does due diligence. You're going to give you warranties. And also at the end, there's an important bit for corporate finance advisors like I would, which is around the balance sheet and the cash. Usually there's a lot of money to be won or lost on the surplus cash or debt in the business. Businesses are bought at a price based on them being cash and debt free and having a normal level of working capital. What is normal? That's where the argument comes. So for example, I always give you a slightly daft example, but if you were selling a Christmas pudding business in February, it would probably be stuffed full of cash. But if I was buying it, I'd probably want you, the seller, to leave some of that cash behind, because you're probably going to absorb a fair amount of cash until you got to peak season again. So that's a real whistle-stop tour of the process. Moving on then to management buyouts. And I'm talking here in exit context of vendor-initiated buyouts, selling to your team. If you have a stable, growing, profitable business, it's a viable option. And the basic structure you may be familiar with. Companies sold to a new shelf company for a fair price. You're going to get capital tax treatment, same as a sale, so 10 to 20%. It's funded by a range of sources from the company itself, if it's cash, debt, loan note from the vendor, private equity. And the management team, of course, need to put some cash in to ensure that they're committed. There's loads of funding for this out in the market right now. The bank's putting in 2-3 times EBITDA for the right business. I guess my other practical points in this are, if you're thinking about this, don't just let your team have a go. I'd be really control freaky about it. If you're the seller, structure a good deal and take it to them, but then it's the deal of your choice. And make sure there's enough scenario planning, particularly harking back to the point about uncertainty. You need to make sure that whatever deal you do doesn't unduly burden the business, because it needs to pay you out effectively. A variation on buyouts, which you probably heard much of, is the employee ownership trust. And John Lewis is very much the poster boy for this mechanism, although in fact it predates the current legislation. The way this works is you have to sell at least half the company to trust. It's very tax efficient for sellers who pay 0 tax, because the aim is long-term employee ownership, and there's terribly unfavourable tax treatment on a subsequent exit if there was one. Funding is quite similar to a buyout, but less flexible. You're not going to get PE interested because there's no easy exit. It comes with the opportunity to give employees up to 3,600 of tax-free bonus, which can be quite attractive. And the employee ownership trust, the key conditions are it needs to benefit all employees on the same terms, and the target must be a trading company. I do think you need to think about cultural suitability. It might need a different culture if you're going to go genuinely all employee. And you need to ask the question about motivation. Will employees actually feel any different? Do managers have enough skin in the game? And I think the other key thing is you need to value your continued independence, because the disincentive to sell, the tax poison pill, can limit strategic options later. A quick compare and contrast of the two, I always think, is quite interesting. They're both addressing succession through slightly different approaches. In terms of the key differences on tax, the employee ownership trust is way better on the way into the deal, but the buyout is better on the way out later. In terms of senior team motivation, I think it's potentially better in the buyout because they can have more skin in the game and they become owner drivers. In terms of customization, slightly more flexibility on a buyout because you don't have the trust structure and rules. In terms of cultural retention in your business, perhaps controversially, I think a buyout is probably better in terms of cultural retention, because for most owner-managed businesses, the shift to an employee ownership trust requires a custodial approach. It's a shift of culture towards that. And in terms of motivation across the company, I think to get it right, it can be very beneficial taking both approaches. So there's a debate to be had if that sort of thing is of interest as to which is best. Very briefly on private equity sales, because that was kind of low down in your list of priorities, I know. This can often be a good way to get partial exit. They'll often buy a majority, but leave key owners with a meaningful minority. So I'm engaged in a company sale at the moment where the seller would happily step out, but equally he'd happily do another 5 years, provided he had 30-40% of the business and had taken a lot of cash off the table. PE investors generally prefer businesses making at least $1 million EBITDA with a consistent track record. So that gives you an idea of scale. It does change the ownership style of the business and is predicated on a later midterm exit. And they will introduce a geared equity structure to the business. So they'll put equity in, but you'll also end up with a lot of loan notes and pref shares, which puts some people off. They do need management to stay in or to manage your exit as a vendor, because they're backing people ultimately. And you pick up some other costs along the way, such as monitoring and board fees. And many will have a yield on their financial instruments. But you need to look at all of these in the round in terms of how good is the deal. I can report there's lots of appetite for PEs to invest now. So if your exit horizon is short term, they could be the best deal. There's quite a few funds out there which have a time by when they have to be invested, Ukrainian war and inflation or not, which keeps the cash flowing in that sort of direction. So when you're looking at all of these, I think the other factor you need to think about always is timing, of course, and it's more about what's going on in the marketplace generally than just what's going on in your business. When we're doing exit reviews, or indeed pitching for sale mandates and transaction mandates with people, we use a traffic light system just to try and assess timing, readiness and appropriateness. This is a made up example I put on the screen. You can reflect whether enough of the lights are green and amber for you, or when you think they might be green. So in this example, this business is in a good sector. It's got good second tier management. So we've got succession sorted. There's a couple of issues in this one which are common to us all. Weak sterling is attracting foreign investment. That clearly helps. And the current tax regime, certainly the capital taxes regime, is as benign as it's likely to get, in my opinion. I don't think that's terribly controversial. So finally, just to try and pull it together, it's a bit like a battlefield out there right now. Now, some of you I know have got longer time horizon, and things might have calmed by then, but I'm sure there'll be some other crisis along. I think the key is to take a lead from the armed forces. I believe that battlefield strategy is conceived as a series of iterative loops. So I think the message from that take home is get your strategy going and keep testing it and flexing it. If forecasting is going to be difficult, then consider multiple scenario planning. Consider reforecasting more often. I think that's the practical way to approach that. We're busy doing deals, and I can certainly confirm that all 4 of these options are very feasible and very doable if your company is going ahead as you expect. Pulling together all of the themes, I mean, people say there's never a bad time to make a sales call. I guess I would say it's always the right time to think about your exit planning. Don't let the current crisis deter you from making those plans. This is all about making an exit of your choosing at a time of your choosing, and you can start today effectively. I really love to hear about people's plans, and so I know John will put the contact details out later on, including email and so forth. But if you do want to connect in LinkedIn, do get in touch. Let me know that you were in the audience, and we can have a chat. That would be great. So I'm going to hand over to John, leaving you with that image, which could be you disappearing into the future with a briefcase full of bearer bonds or something.
Don't leave us yet, Lake.
No.
We've got some questions that we want to ask
Excellent.
you, but I'm going to ask a question of the audience before we start going into the Q&A, just as we collate them. So to give the audience a bit of a chance to actually think of some more questions to ask Lake, I'm going to launch this one. Do you expect to change your strategy following this webinar? And don't worry about the word investment. Let's just focus on strategy. Do you plan to change your strategy following this webinar? I'll leave it there for the time being. I'll share the results. So there's quite a positive yes there. 2/3 of the audience consider that they're going to change their minds. Okay, so we might hear some more on the Q&A as regards what people are thinking about. So our friend Sundip has got a couple of questions in the Q&A, and I'll just read them out. One of them is, how is current inflation affecting the deals made? And how's it going from down to inflation, really?
Yeah, that's an interesting one. I think the real impact of that has probably yet to be felt. On trade deals, not at all yet. And I think the rationale for that, companies are still making good profits. Trade buyers are very much thinking about strategy and what they're going to do going forwards. I suspect it will start to rise in the discussion, particularly in certain industries where there's real pressure on supply chain and margins. That's where it will come through over the next couple of years. The profits will frankly just be lower. So unless you can articulate a good case as to what you're doing about it, business efficiencies, for example, I'm selling one company where it's had a fantastic year. Next year, it's forecasting the same again, which is partly squeezed margins at one end and inefficiencies that they can really demonstrate on the other side. Where I am seeing it already is in deals which are got a significant element of bank funding in them, because the banks are already doing a lot more stress testing around this side of things. So not a huge impact yet, but I can sense it's coming. Of course, it's coming, and the big effect is just going to be on profits and growth, frankly. Growth is probably being strangled for supply chain reasons in some businesses. Others will keep growing, but profits will be the challenge.
It's interesting that you mentioned banks there, because banks do not take risks. So therefore, they're not going to be buying businesses or helping the sale of businesses if they feel that it's too high a risk because of loans.
So I think what comes out of that is the scaling back the amount to which they'll fund things. So that's either going to impact on price or on deal structure. Yeah, you're right. At least they don't knowingly take risks anyway.
Okay. And I know that you didn't elaborate on IPOs because it wasn't something that the audience were really expressing an interest on, but some of it was actually come back. Is IPO not a good exit strategy?
Yes, it is for the right business, and as I say, unashamedly, it's not normally in my wheelhouse. If it's clearly the good direction for people, then I'll shove it in that direction. I'll send people in the direction of someone who can help. IPO is good. In certain businesses, you're going to get good valuations because the market likes them. It's great if you want to go on and make acquisitions, because it means you have quoted paper. I think you need to think, will it serve business purposes? I'm not suggesting for 1 minute any of the current audience are thinking this, but I have seen people going down that route from a sort of vanity standpoint. It does come with ongoing regulation and so forth. But it is an absolutely valid exit. And timing, of course, in IPOs is probably even more crucial than in trade sales, because from what I can see, the stock markets are more fickle than trade buyers in terms of when there are windows open to get decent valuations.
Okay, so we've got a couple of questions on trade. I mean, so what's better, a trade buyer or a private equity buyer?
I think neither is qualitatively what you would prefer. If you look at the statistics, there are periods when trade are paying more or when private equity are paying more. So if it's all about price, you would probably want to test the market. I think if you had a view about the culture of your business, that would influence the outcome. Private equity will have a different cultural feel than sale to trade. And frankly, there are some businesses where private equity will buy it because they can see an opportunity to consolidate or to grow, but there aren't perhaps enough trade buyers with scale to buy the business. So you often find in niche markets, there's a great opportunity to consolidate, but none of your competitors are big enough to buy you. So you end up probably having to look at more of a financial exit. So that's a very long-winded way of saying it depends, John, I'm afraid.
Mm-hmm. Okay, can you unpack a bit more on a trade sale, how it actually works?
Gosh, that's a very open question. Well, process, I guess I sort of outlined, you're either arm wrestling one buyer or you go to market. In terms of the actual process and how it works, it's no different from selling anything else. If you have a buyer in the room, you need to understand what motivates them, why they want your business, and you then need to do some classic selling into that. Negotiation and process will follow. Sorry, John, it's such an open question. I could talk all day about that. I was trying to be concise.
I'll give you 2 minutes. I know I've bought and sold a number of businesses myself, for myself and also for others. And I think I would honestly say that, trade sales, yeah, often it's a competitor. It's to get market advantage, or it's because you've got a product or service that they want to use to enhance what they've existing got to their portfolio, or they just like buying that sector regardless. And I've seen all sorts of examples of large corporates buying up anything in that sector because it's in that sector and they just want to get a presence in that sector. So it's so open. It really comes down to what is it that you actually make or produce or service or provide, and what sector you are in. There was also a caveat question to this, Lake. It was management buy-in. Well, it's the same as a management buy-out. You're either buying in or you're buying out. as an exit strategy. I can't quite see why it would be regarded differently, management buy-in compared to a management buyout.
It's part of a spectrum, really, isn't it? Management buy-in is generally perceived as more risky because you're introducing someone new into the equation. But in reality, they're mostly, and I hate this phrase, what people call bimbos, which is buy-in, management buyout. So yeah, they still happen. And it can actually be a really good answer. If, for example, you're looking at a buyout as an exit route and your team is not quite strong enough, then you can consider bringing someone in to strengthen the team, ideally a little bit before you do a deal so that you can bed them in. And equally, you do quite often see people from outside buying businesses. In the current climate, there are actually quite a lot of people. The sort of profile seems to be who have been to business school and who've got a range of private equity and family office backers who are looking for opportunities. They're probably a bit more of a wild card because unlike a seasoned trade buyer, you don't entirely know how they're going to behave. But ultimately, I guess the money is the same colour as anyone else's.
So whilst we're on the subject of management buyouts, don't they normally pay less than you'd get from a trade sale?
That's the general wisdom. And the rationale for that is that if you're a management team buying a business from a big corporate or something, obviously, ultimately, you've got to raise money somewhere, which constrains you. Whereas a strategic buyer can probably always pay more because they can extract more value out of the business going forwards as part of their group. Where that accepted wisdom falls down sometimes is if you're structuring a deal to sell to your team, because then the quid pro quo is you probably won't get all the cash on day one. You'll get some of it over 3, 4, 5, 6 years. And frankly, it seems a reasonable trade in return for providing that funding that you might get a pretty decent price, or at least a little bit more, because you've had to wait for it. So generally, yes, John, that's the accepted wisdom, but not always. I'd always say to people, have a look at the buyout and see how it would actually work and see how that stacks up. And in some industries, the trade will always blow you out of the water. I looked at a buyout in a telecoms reseller recently where the trader just paying really fancy prices, and there was just no way that we could make it attractive for the seller. In other industries, what the trade might pay will be much more of a level playing field. So it depends on the sector, depends on whether you're funding it. If you have a market where there are strong strategic buyers, that is probably your top price in most cases, but not necessarily.
Okay, so when you're doing your valuation of the company, how do you go about it? Well, what decides the value of the business?
Okay. Well, I guess first, a brief caveat. When you're selling a business, of course, it's about the price tag, not the valuation. I used to say valuation is much more of interest to tax accountants and in the divorce codes and things like that. But for most successful trading businesses, it's going to be a multiple of profit. And we're usually looking at EBITDA. For some technology businesses, turnover multiples can be relevant, particularly early on. And of course, sometimes, particularly if it's an early stage business, people will be looking at the value of the intellectual property. But that's beauty in the eye of the beholder. What can I get from it? Some businesses, it's asset driven. Property investment businesses. For most trading businesses, you're only going to get an asset value if they're underperforming. In other words, they've got an enormous big factory, loads of machines, and they're not making much money. So for most decent trading businesses, it's multiple of profit will get you your valuation. A valuation opinion, the sort of thing you might get in a sort of tax restructuring thing, that has to be very even-handed. So it's an orderly market, no special buyer, no special funding. If you, on the other hand, said to me, I want to sell this business and go to the market, and here are the likely trade buyers, then we'd be talking bigger numbers because we'd be looking at a price sold to a strategic buyer. And you can actually take a feel for what the sort of difference will be in those. So Most people, I think, intuitively will know, yes, it's a multiple of earnings. And usually it would be a multiple of EBITDA. We can do research to see what that multiple ought to be. You then obviously need to do an upward or downward adjustment based on the intrinsic features of the business you're selling, the value drivers. And then there's an adjustment for the shape of your balance sheet. Are you heavily indebted or not? And then obviously, if you're in the sale process, and you'd expect me to say this as an advisor, good process, hopefully will get you the froth on the top of the pint and get you that little bit extra.
Thank you, Lake. And Sundip, I've put Lake's contact details, his email, in the chat room. So if you want Lake to help you with a company valuation, you can actually ask him direct. So I don't believe we have any more questions. So there's no more open questions. So I think what we'll do is we'll give everybody back some of their time because it's a lovely day here today. And I wish to thank Lake for a very informative presentation today. I really welcome his comments and his personal observations, which are very valuable to our audience because they are current and very much up to date. And thanks is coming in from the audience as well. So thank you very much indeed, Lake. We will get you back again, perhaps in about 6 months' time, to give your view on what's changed over the last.
Whether the wheels have actually come off.
Yes, exactly. If anybody was in the business briefing this morning from the British Business Bank and the Bank of England, it is a nice sunny day today, so please take advantage of it because that was about the best news that there was. So yeah, I think it's very, very important that you don't listen to all the doom and gloom out there and focus on the positive going forward. I think we all need to do that. So thank you once again, Lake. Thank you to my team, Victoria and Christian. And thank you to the audience for staying with us today and for participating actively in this presentation. As I said, it has been recorded. It will be made available on YouTube and in a podcast. And if you do have any questions following on from this, then please, by all means, contact us at uez@essex.ac.uk. If I can get it into the chat box quickly, I will do that. It's in the chat box there. UEZ, that's Uniform Echo Zebra, stands for University Enterprise Zone, at essex.ac.uk, and we will forward any questions to Lake on your behalf. So thank you once again, everybody. I wish you a good day, and it's the longest day of the year, so please make your way to Stonehenge. Okay, thank you and goodbye.